The economy created 280,000 jobs in May, beating estimates by about 40,000 jobs. So has the labor market and the broader economy recovered from the weakness seen during the first quarter? And what does this mean for the Federal Reserve's looming policy shift? I want to bring in Sam Coffin, an economist at UBS, and Lindsey Piegza, the chief economist at Sterne Agee, is here with me on set. And Lindsey, I want to start with you. Your reaction to Friday's report. The April jobs numbers were revised downward slightly. March was revised upward. Have we recovered from the weakness seen during first quarter?
Well, I think it was a step in the right direction from that more pronounced weakness that we did see in March, even with that upward revision. But remember, when we look at the underlying momentum, the 3-month moving average is little change, still right around 200,000. So certainly we did beat expectations, but when we talk about underlying strength, I still think we have quite a ways to go before we can talk about a robust hiring sector.
All right, I want to get to Sam. Sam, what's your take on what this means for the Federal Reserve? Do you think they'll hike rates sooner, given the better than expected jobs numbers?
I don't think they hike rates sooner on 1 month worth of data, but I think there were a couple of important improvements here. First of all, wages rising a little faster. We're going to get updates on that in next week's employment cost figures as well. And also that you're seeing further rebound from the port strike, that wholesale and transport payrolls were accelerating pretty decently. And I think maybe that port strike was a bigger impact than we thought on Q1 activity. All right, recover from that.
Lindsey, let me come back to you. You've been saying for quite some time, even on this program, that the Fed can't tighten in 2015. They need to wait until 2016. Yesterday, the IMF came out and said the Fed should hold off until 2016. Where are you on your rate hike expectations?
We maintain our expectation for 2016. As the previous guest said, 1 month does not make a trend. And the Fed is going to be very persistent that they want to see continued strength in the labor market. So we're talking about several consecutive months of above 300,000. Remember, we need on average just 200 to 250,000 to cover demographic change. So first-time entrants into the labor market. So we're still not at a pace where we can talk about a very robust employment sector. Now you couple that with dilapidated household spending, muted business investment, non-existent inflation, and that doesn't spell a recipe for a Fed that needs to raise rates anytime soon.
All right, and Sam, for the markets though, I mean, you mentioned wages. Average hourly wages are now up 2.3% over the past year, so people are making a little bit more money. So isn't that good for the markets and consumer stocks?
It probably is. I mean, overall wage incomes have slowed a little bit in the last several months. That's a result of the work week shortening a little bit. But the broader trends in wages are very positive. We've seen job openings pick up quite rapidly over the last year and a half or so. Historically, that has tended to lead wage gains. We've seen more pressure in the employment cost index, more pressure in total employer costs for employee compensation, beginnings of a pickup in average hourly earnings. We think that kind of pressure on wages, plus payrolls above 200,000 or so a month, is probably enough to help the Fed move this year rather than later.
All right, Lindsey, I'll ask you the same question. I mean, what's your take on how the markets will react to this? Perhaps maybe a sell-off today, and then come Monday, everyone will be on to the next thing?
Well, it seems the market has really been discarding or not believing some of the more lackluster economic data. We've seen just a slew of a malaise across nearly every sector of the economy. So I think this will be another report that the market sort of sloughs off. Again, looking at the fact that we beat expectations, we could see a rally in the market. But again, longer term, when we look to that June meeting, we're going to have to decipher word by word what the Fed intends to do in the remaining 6 months of the year. And I think that will give the market more direction longer term.
All right, all issues will be following. Thanks very much to both of you for joining us. I'm Scott Gam, and you're watching The Street.